Hello, I'm Jacob Reynolds. I'm Head of Asset Management at Courtiers. Today, I'm going to be asking you the question, are these the best opportunities of this century? Now, what we're actually going to do is we're going to be talking about stocks. I'm going to give you a potted history of them. We're going to be introducing some techniques that we use to measure the performance of groups of them. We're then going to use those techniques to discuss what's been going on in 2023 and then stretch that out to show how 2023 is like, whether it is like the rest of history. So, stocks are companies. Where does it all begin? Well, the first ever company was a Japanese Buddhist temple builder called Kongo Gumi. They were founded in 578 AD, and they unbelievably lasted over 1400 years until 2006, until they were liquidated after they succumbed to their wounds in the bursting of the Japan real estate bubble in the early 1990s, and were wrestling with declining temple revenues. Now, this is where it gets interesting for all of you watching. In 1602, the Dutch East India Company became the first publicly listed company. Their trade missions to the Far East were very expensive, so they went out to the public and they said, if you provide us with capital to fund us on these missions, we will give you a share of the profits. That created the first public company. In quick succession to that was the first stock market exchange, because people wanted to trade these entitlements. The trade missions might come back too late for them to realize those profits, and other people will pay for them. Therefore, Amsterdam Stock Exchange was the first stock exchange in the world. Now, roll on 250 years. The world is awash with public companies, and these two gentlemen, Charles Dow and Edward Jones, decided that they needed to find a way of measuring them. So they took various stocks and they started noting down their prices collectively every day in something called the Customer's Afternoon Letter. Now, that became the Wall Street Journal, and it was very successful, and that index was the Dow Jones Railroad Average. The industrial average came 10 years later, but what Charles Dow and Edward Jones wanted to do is they wanted to measure the booming the rail industry in 1884. It wasn't until 1894 that they decided that this was such a great idea, let's try and measure all of America. So they started the industrial average. Now, nowadays we use the S&P 500. That was born in 1957, and it's a market cap weighted index, so it's more relevant and broader. These are some of the indices we follow around the world, but since the launch of the Dow Jones in the late 1800s, hundreds have cropped up across the globe. Now, these are 18 emerging market indices that we follow on our monitors every day, and 28 developed market indices. But we don't just use countries to look at stocks. It's 2023. We have a wealth of mechanisms and analysis techniques to look at stocks. And lately we've been saying the large caps have been doing this, or the value stocks have been doing this. And I want to show you a simplified example of what we mean when we say that. So let's simply take 10 stocks. Let's say the world is made up of just 10 stocks, and these are those 10 stocks. And in the accompanying column, I have their market value. Now, their market value is simply their latest trade price times the amount of shares outstanding. So if you have a company with 100,000 shares outstanding and the last traded price was £1, you would have a market value or a market cap of £100,000. Now, what we do is when we look at the largest companies and the smallest companies, or the large caps and the small caps, we simply create a rank of all the companies, put them in order of this size, and we cut that in half and we say, well, these are the largest companies and these are the smallest companies. Now, we are fundamental investors. We don't just look at size or the market price, we look at what you're actually getting for that market price. As Warren Buffett would say, price is what you pay, but value is what you get. And what we try to get is big streams of earnings, big dividend yields, and good asset bases. And we can use these techniques again to say for each pound we invest, how much of these earning yields, dividend yields, net assets do we get back in cash flow? And then we can rank them again by this, and we can further split the largest smallest companies into large expensive companies, large value companies, small expensive companies, or small value companies. Now, this is where it gets really interesting, is that work done by Kenneth French and a Nobel Prize winning economist, Eugene Fama, showed that they can track back in history and show how these have performed. They were very famous for coming up with the three-factor model by showing that these factors are very important. But what we can do is they provide their data publicly, and we can use those splitting techniques on the actual global stock exchange and show you how you would perform over the long run. So let's just take the US. If you go back to 1951 and just invest $1, just $1 in the small good value companies, in 2023 you would have $58,000. Now, if you invested $1 in 1951 in the largest, most expensive companies, that top box, when we were splitting up our hypothetical global index, you would only have $1,000. You have 58 times more capital, more wealth, if you target small, good value companies. Now, is that what has happened in 2023? Well, no. In 2023, the largest, most expensive companies have been the best performers. They had a torrid 2022 where the Magnificent Seven that James introduced were down 45%, but this year they have bounced back and they are up collectively around 70%. Now, if you strip that out of the S&P 500, and you look at how the other 493 have done, you can see that the biggest, most expensive companies have performed well this year, whereas the market has been largely flat. Now, there's lots of opportunities out there if you invest outside of the big seven, and I wanted to give you some examples to highlight just how big and just how expensive these stocks have become. So I'm going to do that by asking you a question, and that question is, how would you invest £2.33 trillion? If you had £2.33 trillion in your pocket, and I'd said that you have to buy two companies, one is company A and one in company B, how would you do it? So let me give you some of the fundamentals, some of the balance sheet statistics, and these are real numbers. So your first choice is company A. Company A has revenue of 302 billion. Company B has revenue of 1.78 trillion. Company A has profit of 76 billion, but company B has profit of nearly 200 billion. Company A has net assets of 49 billion, and company B has net assets of 1.2 trillion. And finally, company A pays you dividends of 12 billion, and company B pays you dividends of 80 billion. So if you're watching this at home, think to yourself, where would you put your 2.33 trillion pounds? Now, I can tell you, if you'd said company A, you would have bought Apple, and if you'd said company B, you would have bought the entire FTSE 100. The entire FTSE 100 currently trades at a market value of just under £2 trillion, less than Apple's £2.33 trillion, just under $3 trillion is Apple's current market value. Now that leaves you, if you chose company B and you chose to invest in the FTSE 100, that leaves you with £369 billion. That can buy you the entire FTSE 250. So for the price of Apple, you can buy the 350 largest companies in the UK with £8 billion left in your pocket to spend. It's quite a remarkable statistics, and I hope it brings those sort of big expensive stocks versus the rest of the market to life. Now I'm going to give you one more, and let's turn our attention to the car company in the Magnificent Seven. So again, I'm going to give you some stats. These are real numbers, but the figure has gone down slightly, but still a very, very attractive 616 billion you've been asked to spend on a car company. Now, the two car companies that are on offer are Company A, which is going to sell 1.8 million cars this year, versus Company B, which sold 51.6 million this year. Company A has one brand versus Company B, which has 54 brands. Company A has profit of £7.35 billion versus company B with profit of 112.2 billion. And lastly, company A is going to pay you 0 dividends, and company B is going to pay you 38.3 billion in dividends. Hopefully you think to yourself, I'm going to probably put my money in company B. Company A is, of course, Tesla. Company B is the 12 largest car manufacturers in the developed world. It's just simply astonishing that you can get all of these names for the price that Tesla currently trades on. And you might say Tesla is part of the future, and these are using fossil fuels and therefore are not future relevant, but VW alone is going to sell 1 million electric cars this year. Toyota has released a hydrogen combustion engine to accompany its hydrogen fuel cell technology that's worked on the last 2 decades. Stellantis is where it gets very interesting for us, because Stellantis is currently in the portfolios and it pays close 6.5% dividend, but also they're growing profits at 11% a year. Whilst Tesla has been able to sell more cars, they've had to do it at significant discounts to justify their growth, and therefore their profits are actually down 18%. So it's really hit their bottom line, and therefore, if they continue to grow, profits will, at this trajectory, profits will continue to fall. So it's quite remarkable that you can have these statistics. And also, if we look back on the FTSE versus Apple, you might say the same thing about Apple. Well, Apple is always going to be around and it's always going to be growing, versus the FTSE, which is full of more traditional stuff. But that's not the case. FTSE revenue and profit have grown over the last year, whereas Apple's has shrunk. Every product line that Apple produces is shrinking, along with the exception of services, which is only 20% of their business. And with regards to these companies being around forever, it's very rare to be a Congo Gumi to last 1400 years. In fact, it's completely unique. Most of these companies do not survive very long time at the top and in existence at all. If we go back to the Dow Jones that was originally introduced in 1894, none of those companies that were originally included in that index are still in that index. Of the 500 companies that were originally included in the S&P 500 in 1957, just 10%, just over 10%, 59 companies remain. So it's very hard to stay at that level for a long period of time. And it really shows that if you chase those returns, you're going to be chasing the big expensive companies and you're going to be capping your returns in the long run. Now that's the expensive stuff. Hopefully you can see how attractive the alternatives are. But I want to give you another example just to show how attractive the market is right now. And it's a stock that we added to the portfolio in mid-2022, and it's Barclays, and it currently has a market value of 21 billion. It has profits of 4.45 billion, and it has dividends of 2 billion. Yet it has net assets of 56 billion pounds. Barclays' current market value is about 40% of the actual value, the audited value on their balance sheet. Now, I was trying to think of a succinct way to explain this, but all I could think is pound coins on sale for 40p. And what do you do when pound coins are on sale for 40p? Well, you buy a lot of them. And that is exactly what Barclays have been doing. Since 2020, they have done 3.2 billion pounds of share buybacks, along with the dividends that are paid annually of above a 5% yield. So it's looking very attractive. Now, Barclays will be part of a diversified portfolio, but it just highlights some of the funkiness there, how attractive the UK is, but also how attractive some things are when you look outside of those magnificent seven. Now, I said, why does this give us a good feeling about the future? Well, when you divide Barclays' profit by its market value, profit of about 4.5 billion by the market value of 21 billion, you get what's called a PE. And it's simply the amount of time it takes in years to get paid back in profit for your initial investment. Now, Barclays currently trades on a PE of 4.5 times, but think of it as it takes 4.5 years to get paid back. Stellantis is trading on a PE of 3 times. Their current market value is is around £50 million, and they're making profit of around £16 million. So just over 3 times earnings, a PE of 3. Now, why does this get us excited about the future? Well, another Nobel Prize winning economist in 2013 was a guy called Robert Shiller, and he came out with this idea of Shiller PEs. And he showed that these were incredibly accurate at since the 90s at predicting the next 10 years of returns. Now, these are the actual figures that he makes available on his website. And you can see that the US is currently here on the chart. That would indicate, using this model, that the next 10 years of returns from the US is going to be below 5%. Now, where is the UK? It's up here. Using the Shiller PE method, the UK is currently at 15 times earnings. But looking back at Barclays, you know, we go outside of that, and you can get companies at 4.5 times earnings, 3 times earnings if you target stuff like Stellantis and Barclays. And that's going to push your returns way up, way to the left of this chart and up, back higher than the UK. But the UK is currently using this model, predicting around over a 10% return. So it's very attractive. And it's not only, the reason we get excited about this is not just because of the UK, but we don't get scared of where the US is either, because we know it's completely dominated by 7 very large and very expensive stocks. And if you look outside of these, you can actually find value, and you can push that red dot up the curve and make sure that you're not capping out those returns that we showed you in the long run by targeting big and expensive companies. So that's why we get excited about the future. We think that the current portfolio is positioned very, very well for future returns. Now, that's the future. What's around the corner? It's Christmas, and I wanted to bring back the Christmas wish list. And I wanted to just give you some ideas using products that are available and produced by companies in the portfolio, and hopefully you add them to your wish list. You may get them, or you may be giving them. So this year we've added whiskey, Tom and Tao Whiskey. They produce whiskey in Inverness. It's part of the Global ex-UK Fund. That's not because there's been a referendum overnight and Scotland has left the UK. It's because they're owned by a Japanese company called Takara, and it's one of the small caps that we highlighted in the beginning to try and give you those better better returns over the long run. Also on the list is VTech. They're another small cap in Hong Kong that produce toys. So buy these for your grandkids, not only because they're great toys and they love them, but it's also going to fund the 10% dividend that they pay to you in the portfolio. And lastly, if you are going to go out and buy whiskey and toys, please put it on your Barclaycards. Thank you so much. It's been a pleasure to be managing your money this year, and I hope you have a very Merry Christmas.